welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Palantir Technologies, Tesla, and NIO. For Palantir, we're going to be analyzing an article titled, "Could Palantir be the best AI stock?" After that, we'll move on and talk about the latest news updates regarding Tesla and their TSLA stock price, pertaining to a new upgrade by Moody's investor research, which has caused the share price to absolutely skyrocket by around 7.72% lately. Once we move on from talking about these latest news updates, we'll be going over their latest price predictions and where professionals think this company is headed in the future. And of course, I'll give my own educated opinion on this as well. And then lastly, we're going to talk about NIO regarding why NIO shares are absolutely surging right now and how it's great news for NIO shareholders. So for more videos just like this one, remember to go and annihilate that like button right now, comment your thoughts down below about any of these companies, subscribe for more stock news updates, and without further ado, let's jump right into today's stories. You probably know that Palantir is a big data and analytics company that serves both commercial clients as well as government enterprises. However, Palantir is really involved in artificial intelligence, and since AI has flooded investment headlines, let's talk about one of the best AI stocks, which is Palantir Technologies. Artificial intelligence is literally the backbone of Palantir Technologies platforms, to where their AI-driven platforms actually process data through artificial intelligence to give their users very intricate insights, which leads them to making very informed data-driven decisions. So essentially, Palantir interprets large amounts of data, and it gives that company's management a very easy-to-understand dashboard, which we will talk about in just a moment, to where they can make data-informed decisions, thus increasing their capability to bring in more profits, revenues, cut costs, and other things like that. Palantir's platform is extremely versatile, being able to be used across a multitude of different industries, but what investors have identified recently is the company is growing in their overall profitability, which is fantastic news. Palantir's platform, after interpreting data, displays their insights on an easy-to-understand dashboard, which you see on screen right here. The data doesn't take a data scientist or even a data manager to interpret, and instead, any layman, manager, or executive will be able to interpret this data so they can make very informed decisions, and hopefully make the best type of decisions. On top of that, Palantir is also renowned in their respected industry. For instance, in 2021, Palantir ranked as the #1 AI company in terms of market share and revenue, according to International Data Corporation, and on top of that, they were also named an AI leader by Forrester Research. To make this news even better, investors are very excited about Palantir's transformation regarding their overall financials. The main draw to this company right now is that they recently became profitable, and their future projections anticipate further profitability in the future. In the fourth quarter, Palantir crossed a critical threshold by becoming profitable on a GAAP basis, and GAAP is an acronym which stands for Generally Accepted Accounting Principles. And this type of profitability is very important because, in my opinion, this is the profitability that I look at. I don't necessarily just look at adjusted EBITA. So while only $31 million of profits from their revenue, which came in at around $509 million, which represents a 6% margin, it's clearly a step in the right direction for this overall company. And on top of that, Palantir expects to produce GAAP net income as time goes on, so this is very great news for this overall company. Now, management didn't give an exact number, however, they are confident that Palantir will continue their profitability streak throughout the entire year of 2023 and beyond. This shows that management is prioritizing profitability right now, and this means that investors are starting to get excited because their share price is going to start to grow based off of this really good news and hopefully very impressive earnings reports. Most of Palantir's profitability didn't necessarily come from an increase in revenue, but rather a decrease in stock-based compensation at the rate in which they were formerly growing their stock-based compensation at. Investors need to keep an eye on stock-based compensation for this company because if their stock-based compensation, also known as SBC, either decreases or stays the same, we can anticipate further profitability for this company as their revenues increase. However, as a word of caution, I also want to make investors aware that their revenues are anticipated to grow by around 16% for the year of 2023, and this is a far cry from what we were originally promised. Back in 2021, investors were promised a 30% CAGR, which is a compounding annual growth rate regarding their revenues from then until 2025. That clearly did not happen. Then they lowered their overall projections to a 25% CAGR regarding revenues. Again, that didn't happen. That was then lowered to an 18% growth, which is now at around 16% growth. However, this is nothing necessarily wrong with the company itself, and here's why. Due to macroeconomic factors, such as rising inflation, the Fed increasing interest rates, the illness, and other macroeconomic uncertainties, companies decided to cut back on their overall spending, which would include spending money on Palantir's AI technology to give them very in-depth data regarding their company. So the reverse would also apply then, because if the macroeconomic outlook improves, we can see Palantir to start scaling their revenue from that 16% back to that 18%, back to 25% potentially over the next 2 years, meaning that Palantir could actually beat these various expectations, which would reflect very positively on their overall share price. From an accounting ratio such as their price to sales ratio, it's trading for relatively cheap at around a PS ratio of 8 times, meaning that Palantir is trading at 8 times their sales, which is not bad for a growth company, except with only 16% growth, technically you could be on either side of the fence here. Some people think that's too expensive, some people think Palantir is undervalued, but I would leave that up to you personally regarding what you think. So overall, Palantir seems to be offering very strong financials. They have an amazing balance sheet with well over $1 billion. They're not at risk of going out of business, and as they grow profitability, it just reflects on the overall strength of this overall company. Now let's move on to talking about Tesla and why they have recently surged in their share price by close to 8%. The reason for this bullishness in Tesla is due to Moody's investor research, which upgraded Tesla's credit rating to a Baa3, and we'll talk about what that is in just a moment, but essentially this is a very large upgrade, which is causing investors to flock to this company. Moody wrote in their upgrade rating saying, and I quote, "Moody's expectation that Tesla will remain one of the foremost manufacturers of battery electric vehicles with an expanding global presence and very high profitability." End quote. Meaning that Moody clearly thinks that Tesla is a market leader, which they are, and they believe their profitability will improve substantially over the next few years. The reason we know this is because Moody even said that they expect Tesla to deliver around 1.8 million vehicles globally in the year of 2023, which would equate to a 34% increase compared to 2022, and this then will translate to more profitability. Moody notes also that Tesla is anticipating to expand their overall product lineup with the Cybertruck, which is going to also bring in very positive financials later this year. Tesla shows their main strength through their efficiency in their manufacturing. Moody has identified this, and they expect Tesla to maintain an industry-leading EBITA margin because of how efficient they can manufacture vehicles and then sell them at a higher price. Moody also anticipates that Tesla will cut their overall costs by close to 50% regarding their next generation vehicles, which again will boost profitability. And they are mainly referring to what's known as economies of scale, meaning as you make more of something, it actually becomes cheaper for you to produce that thing, which is going to increase your overall EBITA margins and profitability. That's why Moody has upgraded Tesla. But on top of that, not many people remember that Standard & Poor's Global, or S&P Global, also upgraded Tesla last year to a BBB rating, to where an S&P analyst wrote that we believe Tesla continues to demonstrate market leadership in electronic vehicles with a solid manufacturing efficiency that supports strong EBITA margins and sustained positive free operating cash flow, albeit with high capital expenditures, end quote. So overall, this is very positive, and for these upgrades to come year after year, we can now actually know that Tesla is considered a blue chip company, at least in regards to their corporate debt perspective, which is what Moody was originally talking about. There are many ETFs and other passive and actively managed funds that only invest into blue chip companies, and just for those of you who are wondering, 80% of my personal portfolio is made up of ETFs, index funds, and mutual funds, which hold blue chip stocks. So blue chip stocks and blue chip companies are some of the best companies and stocks to buy for your portfolio, and I am living proof of that. So what does this mean for their overall share price? Currently, the company trades for around $196 $97.58. However, very bearish negative analysts who say to sell the company, even though the ones who were surveyed by TipRanks only says that there are 3 of them, think that this company is overvalued, and they say the company is worth $89. Clearly, I do not think that's true one bit. I would actually more gravitate toward a $250 price target, even though the median share price target for this particular company is $212. And out of the 33 analysts that were surveyed, 10 of these analysts say to hold this company, 3 of them say to sell, and 20 of them say to buy because they believe this company is worth around $300. So I leave that up to you to decide, but regardless, this company has huge upside growth potential. Lastly, let's round out the video talking about another electric vehicle company located over in China, and that is going to be NIO, in which NIO shares have actually risen recently by around 6.4%, and they are continuously rising. So what is making NIO rise? Well, as of late and over the past few months, the share price has actually dropped by around 30% since their recent highs. This decline in their share price has caused the company's market cap to drop under $14 billion, which is a screaming buying opportunity in my opinion. The reason why NIO's share price is increasing is due to an article written by Barron's, which says that NIO is extremely competitive over in the Chinese market, giving competition to not only Chinese EV makers, but also Tesla as well. One of NIO's main competitive advantage, besides having very cheap luxury vehicles that look amazing in my opinion, is their technological advantage regarding their battery as a service offerings, also known as a BaaS offering. This allows customers to pay a monthly subscription to not only pay to rent their battery, but also it gives them access to battery swapping stations. So instead of going to a charging station, which takes well over 10 minutes even from superchargers, NIO allows their customers to enter battery swapping stations, which is exactly what this is on screen, to where their battery will be completely replaced in a matter of minutes. Much faster than any supercharger or regular charger that is on the market right now. NIO has announced their next generation battery swapping stations, to where each of these stations are capable of transferring and swapping out 400 batteries per day, and that's a 30% increase from their old stations, meaning that they are rapidly increasing their overall technological advantage. The company had also previously said that they plan to ramp up the amount of stations that will be live and built during the year of 2023, to where the next 10 stations will go live on March 28th, making another great catalyst for this company. With more than $7 billion worth of sales in 2022 and a market cap below 14, their PS ratio is very cheap. NIO is trading at less than 2 times their sales multiple right now, making this not only a phenomenal growth stock, but also a phenomenal value stock with huge upside potential. Overall, I would say NIO is very well positioned for future growth, as well as Li Auto. In the end, we can see great news updates across the board for Palantir, Tesla, and NIO, but I would love to hear your thoughts down below. Don't forget to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and I will see you in the next YT video.